I just poured through a decade of ruthless market data on every single one of the 34 Charles Schwab ETFs. And the horrifying truth is that choosing the crowd favorite could literally cost you years of your hard-earned retirement. $10,000 was my starting line for each fund. What I discovered was a hidden champion that mutated that initial 10 grand into an astonishing $54,000, while the widely praised safe options quietly suffocated in the background. But hold on, because the fund that actually won this grueling 10-year war is hiding a massive, terrifying flaw that no one wants to admit. I will reveal exactly what that fatal flaw is before we are done here. Sitting alone in my dimly lit office, I stared at the spreadsheets until my eyes blurred, determined to separate the real wealth builders from the sophisticated financial traps. Everyone assumes bonds are the ultimate safety net. I looked at the bond funds first, expecting a boring but stable foundation to protect my hypothetical $10,000. The inflation-protected securities managed to scrape by, pushing the balance to a pathetic $12,900, barely keeping its head above the rising waters of inflation. Bonds did their one miserable job of preventing total collapse, but they certainly did not build an empire. I knew I had to look deeper into the equity funds to find where the real money is made. This is the exact moment everything started to get incredibly complicated. Schwab essentially runs two entirely different philosophical systems for their index funds. One system is built purely on company size. The other is built strictly on actual business fundamentals like sales and cash flow. These two systems have been locked in a vicious, bloody battle for the last decade. Who won? The answer to that question completely depends on which side of the ocean you are looking at. I started digging into the domestic U.S. matchups, placing the plain funds right alongside their fundamental twins. It was an absolute slaughter. In America, the plain, unthinking funds absolutely decimated the meticulously calculated fundamental funds in 3 straight, embarrassing matchups. I could not believe what the numbers were screaming at me from the screen. Why did the supposedly smarter, cash flow-driven strategy fail so miserably in the United States? It all came down to a lack of discipline being rewarded by an irrational market. The fundamental funds are explicitly designed to pull back from aggressively overpriced companies. Sadly, those aggressively overpriced mega-cap tech giants are exactly what carried the entire U.S. market for the past 10 years. Discipline actually punished the fundamental investors, stealing away their potential fortunes while the reckless momentum chasers bathed in profits. But do not adjust your portfolio just yet. I am about to show you how this exact same logic aggressively backfired the second we crossed international borders. The twist is coming, and it will change how you view global investing forever. Before crossing the ocean, I had to confront the ugly truth about the funds that got completely left in the dust right here at home. I sorted the data by market capitalization. The results formed a perfect, descending staircase of despair. Large cap value held up the best, managing to crack $30,000. Mid caps fell below that, and small caps sank even deeper into the abyss. It was not a random coincidence. When interest rates violently spiked, the smaller companies carrying heavy, floating rate debt were absolutely crushed under the immense financial pressure. Size was the only armor that mattered in that brutal environment. But remember what I said earlier about the market leaderboard moving violently? If you only look at the last 12 months, the entire picture flips violently upside down. Those battered, bruised small-cap companies suddenly exploded upward the moment rate cuts were even whispered on Wall Street. The decade-long losers transformed into the immediate short-term champions overnight. This is why you can never trust a one-year performance metric. It is an illusion, a temporary trick of the light that fools amateur investors into buying at the absolute peak. True wealth requires the agonizing patience to hold on for a full decade, weathering the terrifying storms that wipe out the weak hands. I took a deep breath and turned my attention to the income corner of the Schwab lineup. This is where the absolute most popular fund on the entire platform resides. You probably own it. Your friends definitely own it. And it completely missed the greatest technological rally of our generation. The golden child of dividend investing proudly turned 10 grand into $33,000. That is a respectable, solid number that lets people sleep peacefully at night. But there is a dark side to this beloved dividend powerhouse. It's incredibly strict, backward-looking inclusion rules forced it to completely ignore world-changing companies like Nvidia and Tesla. It systematically excluded the precise engines of extreme growth by design. Sure, it won the income category cleanly, but it left massive amounts of money sitting untouched on the table. Could a disciplined, smart beta system ever actually win, or is it doomed to underperform forever? I finally looked overseas to find the answer. The data shifted, and everything I thought I knew was instantly shattered. In the international markets, the fundamental system absolutely obliterated the plain, market cap-weighted system. 3 separate matchups, and 3 sweeping victories for discipline. It was a complete and total reversal of the American massacre. Why did it work so flawlessly over there? Because there was no massive, concentrated tech bubble warping the entire index overseas. Weighting companies by real, tangible cash flow finally rewarded the patient investors who bought into cheap, fundamentally sound European and Japanese businesses. While everyone else was blindly chasing American tech stocks, the smart international money quietly compounded into a massive fortune. The International Large Cap Fundamental Fund snagged a shocking 41% return in a single year. But wait, I have not even revealed the single biggest disaster hiding inside these index funds yet. It is a hidden concentration risk that could wipe out your emerging markets portfolio if you are not careful. The plain emerging markets fund has a horrifying vulnerability hiding in plain sight. One single company makes up an absurdly massive percentage of the entire supposedly diversified fund. You are essentially gambling 1 out of every $6 on a single semiconductor manufacturer halfway across the world. If that one company stumbles, your supposedly safe index fund plunges straight off a cliff. The fundamental version completely fixes this terrifying flaw by forcing the money to spread out across cheaper, less heavily weighted companies. That simple structural difference saved investors thousands of dollars over the decade. I sat back and stared at the final, master spreadsheet containing all 34 funds. It was time to crown the undisputed king of the decade. The top 5 spots were completely dominated by massive U.S. stock funds. No bonds, no international funds, no dividend darlings made the cut. The absolute numerical winner was the Large Cap Growth Fund, ending the grueling 10-year marathon with an explosive $54,000. But I promised you earlier that this champion had a terrifying flaw. Here is the agonizing truth about the winner. It is essentially just 10 giant tech companies hiding inside a trench coat, masquerading as a diversified fund. Almost 60% of your money is chained to the fate of a tiny handful of colossal tech behemoths. If those few companies continue to dominate the globe, you will look like an absolute financial genius. But the second they crack, the second regulation or competition brings them down, you are the most dangerously exposed person in the room. It is a massive, concentrated bet disguised as passive investing. Is there a better, safer way to win without losing sleep? The data offered me a second, much quieter champion. The total market fund quietly slid into 3rd place over the decade. It destroyed the beloved dividend fund, the smart fundamental funds, and all the international hopefuls without breaking a sweat. It will never generate explosive headlines. It will never be the hottest topic at a dinner party. But it simply never finishes near the bottom, steadily compounding your wealth year after agonizing year. We desperately searched through all 34 complex ETFs to find a clever, sophisticated strategy. As it turns out, the absolute smartest play was the simplest, most painfully boring option on the entire list. One fund gave us the biggest, flashiest number, but the other fund gave us the undeniable peace of mind. Now you hold the dangerous knowledge to choose exactly which kind of investor you want to be. The clock is ticking on the next decade of explosive wealth creation, and your move is all that matters now.